Hello, good evening. Can you guys hear me? Oh shit. Maybe
Yes, yes.
let's have an interactive session, please, right? So, before we get started, today, let's run a quick revision, right? Let's run a quick revision on what we've done so far. All right. So far so good. We've looked at market structure. We've looked at we looked at short-term highs and short-term lows, right? Another market structure, I believe we saw we treated efficient and inefficient price action, targeted and protected highs and lows. So please, Emmanuel, off your mic first for a minute. It's echoing. Right, so I believe we treated targeted and protected highs and lows, efficient and inefficient price actions, um, short-term highs and the rules surrounding it, liquidity and the types of liquidity, that is both static and dynamic liquidity. We saw imbalances, right? Am I correct? I think those are the things we've looked at so far. Those are the things we've looked at so far. So I said let's just quickly do a recap before we start today's session. Right? So Jin Sung and Emmanuel, I think only two of you are here for now. Let me see. You can unmute your mic. Let's just talk. Let's talk briefly. Let's just do a recap before we continue. Okay, so yeah, good evening. Good evening.
My name is
Myke, I keep forgetting. You told me once, but I'm just used to pronouncing what I say. All right, so let's get started. So from the class yesterday, I said, what can you regard as an inefficient price action? I want us to just have a brief interactive session before we go on. Right? So from the class yesterday, what can you identify? What can you call and like to your knowledge, what do you think an inefficient price action is now? Someone should answer, please. Emmanuel.
All right. Um, it's the gaps, right? The gaps that the market usually leaves, and
Those are imbalances.
okay, those are imbalances. Okay, inefficient price action. Okay, I think what would be the word? Michael, please try.
Michael.
Okay.
I'm listening. I'm with you.
Are you listening?
Yeah, I'm with you. Go on.
Hello?
Yes, I'm with you. Go on.
Okay. So I think you said inefficient price action is the space.
I think people are saying the same thing. Yes. Let me just explain it again. Right, so I said ideally, yeah, in a balanced market, ideally for every buy there must be a sell. Right? For every buyer there must be a seller, and for every seller there must be a buyer. Right? Now, after an impulsive buy happens, right? After there have been an impulsive buy or there has been a series of buys, there has to be a correction. Right? I'm using buy as an example here. This applies to both buys and sell scenario. Now there has to be a correction, and this correction has to run at least into 50% of the previous structure. I believe I mentioned that yesterday, 50% of the previous structure. And now for structure, what we are considering a structure is liquidity sweep, high, and a break. Liquidity sweep, a valid high, and a break. Now, and I think I this as like when you see something like this it breaks here and it just comes back to test this point and go up. This cannot be an efficient price action because we didn't see price trading back into because we didn't see price trading back into the 50% region here. The price wants to come back to fill at least 50% before the correction is over. And once you don't get that, it means there are gaps in the markets now, right? The price is not efficient enough. Price has to come back and fill it. Now, in a scenario whereby you get the short from somewhere up here, you can target below the 50% here now because you know that that level has to be filled. Are we together? There are sometimes when I'm taking a trade here, I go beyond, let's say, because this looks like a targeted low now to me if this liquidity sweep is valid 50% level over here. Because I know that there will still lapses here and price has to come back and fill it before we continue running up. Does that make any sense?
Your network cracked a bit, but I think I understand what you're trying to say, but you can come again.
Okay, the idea behind an efficient market, right, is this. Let me use what's that one? Okay, so the basic idea behind an efficient market is when you have something like this, right? This right here is going to, let's see, this serves as our break of structure, right? The idea behind an efficient market is price drives back, price trades back into 50% of the structure before going to break the next structure. Before it returns to break the next structure. That is the idea of an efficient market. That is the idea of an efficient price action. Because everything is evened out at that moment. If you look at it on the higher time frame, you notice such market has lesser fair value gaps because the market is very balanced. And it might seem slow or something, but that is a good and healthy market. A market like this would be full with a lot of volatility. You'll just be seeing spikes up and down. You'll be seeing a lot of dildos, that's long candles coming everywhere. I don't know if that makes any sense. I hope this makes sense. So this is an efficient price action. This is an efficient price action. Right. So let's talk about liquidity too. There was something I wanted to teach you guys about liquidity. Right. So I think I'll just add that into what we're doing today. Yesterday, what is a dynamic liquidity based on our class of yesterday? Because I explained it. What's a dynamic liquidity? Anybody, please try.
Let me try. Yesterday when we were talking about dynamic liquidity, there was one word I noticed you mentioned, moving average, right?
Exactly.
Yes.
Right.
So the dynamic liquidity is when the market comes to seek liquidity, let's say below the moving average or something like that. I
No,
have a
dynamic liquidity, based on the explanation I gave yesterday, is when liquidity exists along the moving average. Right? It's dynamic because it isn't static. I mean, like we have liquidity at a point, but the moving average moves. It's more or less, it looks something like this. The moving average is always look like this. Let's say something like this. How your moving average looks, right? And that's how your moving average is going to look. Let's see the candles trading. Where's the path to? Where is this? You can see things like this. See something like this. Price will break. Something like this. Right? You can see something like this. Now, this liquidity is existing along the moving average because you cannot categorically say there's liquidity along the trend line because technically it has swept it. Cannot just state that there's liquidity on this trend line because it has swept it. Which means if you should get an opportunity to short, you can just short it to whenever price breaks below the moving average, regardless of the position it is. Are we together? So which means even if the moving average should, let's say it goes like this, I cannot edit this. Alright, but even if it goes up a bit, once price comes below the moving average, you close whatever trade you are on. Not together, because now there's liquidity line along this moving average. That is why it is known as a dynamic liquidity because it isn't static. It moves. I hope that makes sense. Michael, I hope it made sense. Are we together?
Raising his hand. I don't know.
Oh.
Maybe
It's like he left and he joined back because I permitted him to speak earlier. Okay, I've done that. I've fixed it. So I hope that made sense. Can you hear me, Michael?
Yeah, I can hear you. My network is bad.
Oh, shit. Okay, so let's proceed into what I said I was going to show you today. There's something I wanted to touch today under liquidity. Now, should I touch this in liquidity or should just let's combine this with power of three candles here. We're going to combine these two together. Power of three candles. Now, this is something that you use when you are trying to catch retracements. Right? Use it when you're trying to catch retracements, mostly as you're trying to catch a reversal trade. The power of three candles. I'm going to combine it with liquidity. Right? Now, the liquidity here I'm going to explain is one you could always use to get continuation setups. Because I don't think I've mentioned this. In as much as liquidity lies at every high and low in the market, liquidity also lies at every single candle high and low you see. So if you see, maybe you should see something like this on the charts. Let's look for an example. If you see something like this on your chart, this point here, you see something like this on your chart. This counts as a valid liquidity sweep. This counts as a very, very valid liquidity sweep, in fact, because there's also liquidity line at every single candle high and every single candle low in the market. Now, provided the candle that takes out liquidity, doesn't have its body below the previous candle and closes above the high of this previous candle, it can serve for you. It can serve as what do you call it? A liquidity sweep for you. And this brings us to the power of three candles.
okay.
Are we together?
So as long as it closes, it does not close below the previous candle, and then it closes above.
No, as long as the body doesn't close below, which means if these green parts went below this point small, it would have been a problem for me. I wouldn't consider it. But as long as it is above the low and it closes above the high. You know, in a candle, yeah, this is how a candlestick looks. This is how a candlestick looks, right? Let's get what we use as our wicks. This is this. So we're going to use this as our wick. Let's see. Something like this. I don't know why. Okay, so we have this as our candle, right? So let's look at this as our candle. Now, if this is a red candle, if this is a bearish candle, right? If this was a bearish candle, this is going to be the open, and this is going to be the close, right? Which means this is the high, and this is the low. Are we together? And if this was when we're talking about high and low, we don't necessarily have to involve the wicks. Brother, sorry, when we're talking about open and close, we don't involve the wicks. When we're talking about high and low, we involve the wicks. So like I said, as long as this candle, the wick swept below this, and it doesn't have its body, that is any of this color, like any of the body of the candle doesn't form below the previous candle. Are we together? If none of the body forms below the previous candle, the wick sweeps below and take the previous candle like this. You can consider it a valid liquidity sweep. Now, here's the beauty of this. The beauty of this is the fact that you always have to wait for the third candle, and after the third candle has formed, okay, see another example here. This is another example, a valid liquidity sweep. And you're going to notice that whenever this happened, price continued going upwards. Look, it happened, price went upwards. Whenever it happened, price continued going upwards. I'm looking for the example. I can't classify this because this is supposed to be a good example, but it was at the premium level more or less. Yeah. No. Let's see, can I get another example for you? This is another example here. Swept and continued. Now, let me explain the power of the three candles for you guys to understand. So the power of this liquidity sweep, you want to wait for the next candle to form. That is 1, 2, and 3. Don't always wait for the next candle to form. Now, the basic rule is this: after the next candle forms, whatever candle forms as the fourth candle mustn't close below this level. That is like the basic rule. Mustn't close below this candle. That's the third candle. Now, once you've seen this third candle, you can drop down to your 5 minutes time frame to look for a trade. 80% of the time, most times rather, price is going to sweep the nearest liquidity and tap you in. Now, you on your own part, you're using this point. Sorry, this third candle, you're using this third candle low as your stop loss. You're using this third candle low as your stop loss. You don't really have to stress yourself. And this works on the 1 hour time frame, it works on the 4 hours time frame. Now, from the 1 hour time frame, you can just drop down to the 5 minutes straight top. From the 4 hours time frame, you can go to what time frame? From the 4 hours time frame, you can go to 15 minutes, I think. And it's actually 30 minutes time frame. And it's as easy as that. Right? Look at another example. 1, 2, 3 candles. Now you're going to drop down. You're using this as your stop loss. That is the high of this third candle. Using it as your stop loss. You drop down to your lower time frame to check for your just check and identify the nearest liquidity. I'm going to drop down now so you guys will see too. This is the third candle, right? You notice that price never came back to sweep it. Price just rallied upwards, took whatever liquidity you wanted to take and continued selling. So now the 5 minutes time frame, you can use whatever entry mode. Oh shit. Give me a moment. Let's just see it here. Let's just see it here. This is over here now. Over here. So on this 5 minutes time frame now, oh boy. On this 5 minutes time frame now, you can just come here and you're going to remember your stop loss is going to be above that second candle high, regardless of what price is doing up here. It doesn't really concern you. I think if you notice a very efficient price action. The price action here is very heavy. The price doesn't have any business coming back there. Now, where your problem lies is where price looks like it's inefficient, and this is it. There's a fair value gap here, and there's liquidity here. So basically, you're going to be taking this trade off this fair value gap here. Stop loss is going to be at the high I told you. And the best part of this is that you can always target the 1 hour time frame targetedly. So which means you have the opportunity to get more RR, like you have the opportunity to get more reward. Are we together? Can you guys hear me? Please, am I making any sense? In this case, the one hour targeted low here was this point. If I'm not mistaken. Yes, just be around this point. But left for me, I wouldn't have targeted it because of this security sweep. I would have taken my trade, and this would have been my take profits up here. This would have been where I would have taken my profit if I was on this trade. Are we together? Jenson, I see Jenson. Michael, are we together? Emmanuel,
Yes, we are together.
any sense?
So my question would be, do we trade
This is
this
7 hour.
mostly?
Sorry?
All right, no, finish your illustration so that I'll ask without interrupting you.
Yeah, breaking to a large extent, actually. I didn't get that.
Okay, can you hear me now?
Yeah, go on.
Yes. So my question is, this is traded for continuations, right?
Yeah, use it mostly for continuations. It is recommended using mostly for continuations. It's recommended using mostly for continuations. When you have already established what trend that the market is on, like this, we already know it's an established bearish market. That's it. So you just want to use the power of three candles. To, and it's something that plays out a lot. If you should settle down to go through it, to backtest it, you're going to notice that whenever I see it, this is an example over here now. Whenever I see it from, you hardly see it. Here's an example here now. Look, 1, 2, and 3. This is the third candle. This was liquidity sweep, and this is our third candle. So we're going to use. Might remember, stop loss is at this high here. Stop loss at this high. Interested. Go down to 5 minutes time frame. Stop loss is at that high. We've identified all our levels basically. On the 5 minutes time frame, we're going to just be looking for an inefficiency in price delivery. And I think this has something to do with the news. This should be around the time of the news release. Now, let me make this clear. Try not to trade news if you are scalping. So this was supposed to be a very good trade. You can see it sold down because it didn't like it's played out accordingly to, like as this in text, because this candle was formed by the news. Let's get that. Sorry, give me a minute. Are we together? Okay, this guy is out again. Permitting to speak. Are we together? Michael, can you hear me now?
Yeah, I can hear you.
Right. I don't know, did the explanation make any sense?
I didn't really get the explanation, but because of my network.
So, okay, you didn't get it because of your network.
Yeah.
Basically, once you see.
Okay.
Sorry? I didn't get you.
No, go ahead.
Okay, so the power of three candles again, I'll just run through it. You observe 3 consecutive candles, yeah? As far as the previous, as far as a candle high, like low rather, the candle sweeps the liquidity. Where is that illustration I used? There was a schematic I drew. Where is it? Why can't I find it now that I need it? Don't start drawing number one. Right, so basically, as long as you see price, as long as you see price taking out the previous candle high, like immediate candle high, as long as price takes out the immediate candle high, you can always expect that it takes the price taking out the immediate candle high and closing as an example here. I'm just using low like in a very should I say a loose manner because it can be low, it can be high. So as long as CPI is doing that, it is you can get a trade off it basically. Once you see something like this, because see this candle here coming to sweep the low of this candle. What I'm saying basically is that liquidity exists at every low, like every candle low. You see price sweeping this. The wick of the candle closes. The wick of the candle is the only thing below when the candle closes. The body doesn't go below this level. The upper body closes above the high of the previous candle. And the third candle, altogether, get this, the third candle closes above the high of this two. That is the important part. The third candle closes above the high of this two. You can basically get a trade off this and use this point, so as this third candle low as your stop loss. You can basically get a trade off this as this third candle low as your stop loss. They'll come back into this as their other block. You would have taken your trade with the movements that broke the structure and gotten out. That's the best part. In this scenario now, if you're taking a trade of this, you can be targeting the market high at this point. You can basically be targeting the high or the low that was meant to be taken out. Does that make sense? So in a scenario like this, if you want to take a trade from this point, basically what you're just going to be targeting, you're not going to stress yourself too much. What you're just going to be targeting will be probably this high here or this high. And that is that once it runs, it gives you a profit, you get out. So like I said, you drop down to the 5 minutes time frame and you look for any inefficiency in price. Any inefficiency in price level. Let's go back to the example I used earlier. Right, so there was an example I used. Where is it? There's an example I used. What is it? This is the example here. This was the example I used. So this was from the 1 hour time frame. We saw our liquidity, our candle sweep. Now after getting that, just drop down to the 5 minutes time frame. You are looking for any inefficiency in price. Right? Everything happening above the high of that candle, that's the point I told you to use as a stop loss. Anything happening above that high is not your problem. Don't concern yourself with it. Concern yourself with what is happening below that level. Now, this is the high that I marked as a stop loss level. Now, this is where we concern ourselves. This fair value gap here. This is the inefficiency we want. This is the inefficiency we are looking for. This is the inefficiency we take our trade from. Take our trade from here. Stop loss is at this high. That is the high of the candle. That's the third candle there. And your take profit is going to be like at the targeted low or whatever you're using from the 1 hour time frame. But in this case, I was using the FVG targeted fair value gap because it was expected that price was going to come and fill it. Where is that? Okay, so this is the fair value gap here. Right here. This fair value gap is expected because this is a targeted low already. This low was targeted, but to play safe, let's know that price will come and bounce off this point, then rally up, take you out, and come back to wipe it. Just take off your trade from. Just use this as your take profits. That is the beginning of the fair value gap. It is as simple as that. Does that make sense? The video is recorded. You can always revisit it later if you don't understand anything, and you could always ask questions where you have. So this is on power of 3 candles. This is it on power of 3 candles. I treated it along with liquidity. Can wipe this two off. Just wipe this two off. So basically, we are left with 3 things: premium and discount pricing, AMD, and pattern recognition. Am I right? So basically, we're left with 3 things: premium and discount pricing, AMD, and pattern recognition. And all these 3 things, we're going to visit them. We still have a couple of days left. So we're going to visit premium and discount pricing tomorrow. Then we'll treat AMD the next day. then pattern recognition before we're going to do the putting everything together and the live trading sessions. I believe that makes sense, right?
Yes, sir.
That's here for today. Right? We can call it a day here. Is there any question? Are there any questions?
I think this is one of the easier, simplest. I wouldn't say easier, but simplest. Uh, the simplest entry models was after actually treated so far. But let me just paraphrase. So let's be sure we because I when you talk, I break them down into rules. So I just want to be sure I'm writing down the correct thing. All right.
Okay, go on.
All right. So the first rule. Let's say we are looking at uh, an uptrend.
Okay,
Yeah, an uptrend continuation upward, right? So the first rule is the second candle body does not close below the the wick. The wick does sweep it. As the wick does sweep the liquidity off, but the body doesn't close below the previous candle. Is that
yes,
correct?
yes,
Okay. Then the next rule is we wait for the third candle to form, right?
exactly. Mm-hmm.
So once we see our third candle forms and then it forms above, we are looking at an uptrend for instance now. We look for we drop down to the lower time frame. For 4 hours we drop down to 15. For 1 hour we drop down to 5. Correct. So look for
Yes,
inefficiency. To look for inefficiency.
exactly. You look for any you're looking for the inefficiencies below or above. Okay, like I said, you're looking for the inefficiencies. If it's in an uptrend, you're looking for the inefficiencies above the low of the third candle, which means anything happens. You just want to know what is happening above. That is where you're looking for an inefficiency. I hope that makes sense.
Yes, yes, that makes sense. So I just wanted to be sure I got the rules down properly. That was why I was asking.
All right,
All right,
then.
thank you.
You're very welcome. So I guess this is where we're going to be calling it a day for today. Um, Tomorrow we'll continue our premium and discount pricing. So that's that on Power of Three Candles. Do have a wonderful night and thank you for joining.
Yeah,